Mr. AG here, Asian guy. And I need you to stay with me for the next few minutes because what just happened to silver is not a simple story, and if you only read the headline number, you are going to miss what actually matters here. The headline says, silver crashed 6% to $73 on COMEX. MCX Silver March futures closed more than 4% lower. Speculative long positions just hit a 2-year low according to the latest CFTC Commitment of Traders report. And there is a technical pattern forming right now that every serious silver watcher needs to understand before the next Asian Open. I am going to walk you through every single piece of this. The price action, the positioning data, the margin situation, the technical floor, the macro drivers, and both scenarios for what comes next. Because both scenarios are genuinely possible right now, and anyone who tells you they know for certain which one plays out is selling you something. I am not selling you anything. I never have. I never will. This is just the raw picture, clearly explained, so you can think for yourself. Before we go any further, I want to say something directly to the people who are new here. Welcome. My name is Mr. AG, Asian guy. I do not sell signals. I do not sell mentorships. I do not run paid groups. I do not offer subscriptions or memberships of any kind. My channel is MRAG Asian guy, and that is the only place on YouTube you will find me. If anyone is approaching you, claiming to be me, or claiming to be affiliated with this channel and asking you for money or offering you a service, that is not me. Block them immediately and protect yourself. I share data. I explain what is happening. I give you both sides of every picture. That is the entire value of what we do here. And if the messages I have been receiving are any indication, it is working. Because people are telling me they are finally seeing both sides of these markets clearly, instead of just being told what to think by people who have a product to sell them. That means everything to me. Now let us get into it. Let me start with the number that everybody is talking about tonight. Silver on COMEX fell as much as 6.3% to a low of $73.60 per troy ounce. In morning trading, it stretched further, down another 0.67% to trade at $72.86. On MCX, Silver March futures closed the last trading session 4.33% lower at 2,29,000 rupees per kilogram before recovering, slightly, gaining 0.63% to 2,30,000 rupees per kilogram. These are significant single session moves. A 6% drop on COMEX in a single session is not noise, it is a signal. The question is what exactly it is signaling. And to answer that properly, we need to understand the specific conditions that produced it. The two primary drivers cited for today's pressure are first, low liquidity on account of holidays across Asia, and second, softer U.S. inflation data fueling expectations of future Federal Reserve rate cuts. Now, at first glance, that second point might seem counterintuitive. Softer inflation, more likely rate cuts, lower rates are generally good for silver, because silver pays no yield and becomes relatively more attractive when the opportunity cost of holding it decreases. So why would soft inflation data be pushing silver lower? Let me explain this mechanism clearly, because it is one of the most misunderstood dynamics in precious metals trading. When inflation data comes in softer than expected, it does two things simultaneously. Yes, it increases the probability of future rate cuts, which is structurally positive for silver over a medium-term horizon. But in the immediate short term, softer inflation data also reduces the urgency of holding silver as an inflation hedge. If inflation is cooling, the immediate case for owning silver as protection against currency debasement and purchasing power erosion becomes slightly less urgent for short-term traders. Not for long-term investors, but for short-term traders who are making positioning decisions on a daily or weekly basis. The inflation hedge premium in silver gets compressed when the inflation data comes in soft. That is one part of what we saw today. The second part is the liquidity context, and this is where the Lunar New Year factor becomes critical to understanding today's price action. Markets across mainland China, Hong Kong, Singapore, Taiwan, and South Korea are closed or running at significantly reduced capacity due to the Lunar New Year holiday period running from February 16th to February 23rd. Think about what that means for the silver market specifically. China is the world's largest silver-consuming nation. Chinese industrial demand for silver in solar panels, electronics, and electrical infrastructure is enormous. Chinese retail investment demand for silver has been a significant driver of the recent rally toward $120 per ounce in late January. When Chinese markets are closed and Chinese buyers are absent from the market, you lose a massive source of buying support. What remains is a thinner, more volatile market where smaller order flows can move price more dramatically in either direction because there are fewer counterparties to absorb those flows. This is exactly what we are seeing today. The 6% drop is partly a reflection of what silver actually wants to do on its own without Asian participation propping it up. And here is the honest implication of that observation. When Asian markets reopen after Lunar New Year and Chinese buyers return to full market participation, the trajectory of silver in the following sessions will tell you a great deal about whether the January rally toward $120 per ounce was driven by genuine structural demand or by speculative momentum that has now exhausted itself. If Chinese buyers return and step in aggressively at $73 because they view it as an attractive discount, that is your signal that the structural demand story is intact. If Chinese buyers return and continue to sell or stay on the sidelines, that tells you something very different about the nature of the January rally. Watch the first full week of Asian market participation after the holiday ends. That is your clearest real-time signal. Now let me get into the CFTC data, because this is the piece of information that I think is most underreported in the coverage of today is silver move. And it is extremely important for understanding where we actually are in terms of market positioning. The latest CFTC Commitment of Traders report shows that non-commercial traders, meaning speculative money, reduced their net long silver futures positions by 2,900 and 22 contracts to 22,955 contracts as of February 9th, 2026. That 22,955 net long position is a 2-year low. Let me say that clearly. Speculative long positions in silver futures are at their lowest level in 2 years. COMEX speculators similarly cut their net long gold positions significantly in the same period. Now, there are two completely opposite ways to interpret this data, and I want to give you both of them honestly because they lead to very different conclusions about what comes next. Interpretation 1, the bearish reading. Speculators are losing confidence in silver. The smart money, or at least the fast money, is reducing exposure. When non-commercial traders cut their longs, it typically means the momentum that drove the rally is fading. The people who were betting on silver going higher are quietly walking away from those bets. This reduces the buying pressure that has been supporting price on any given up day, and it means that future rallies may struggle to find the same fuel that powered the move from $30 to $120 over the past 12 months. If speculative positioning continues to decline, the market loses a key source of incremental buying demand, and price may continue to drift lower or trade in a compressed range. Interpretation 2, the contrarian bullish reading. When speculative positioning reaches a 2-year low after a period of extreme volatility and price correction, historically, that has often marked a sentiment extreme that precedes a reversal. Think about what a 2-year low in speculative longs actually means. It means the majority of weak-handed speculative longs have already been shaken out of their positions. The people who were in silver as a quick trade chasing momentum have largely been forced out by the volatility and margin pressure of the past few weeks. What remains is increasingly composed of longer-term holders with stronger conviction and more substantial capital bases, who are not going to be scared out by a 6% single-session move. In this reading, the low speculative positioning is a sign that the market has been cleaned up, the leverage has been reduced, and the conditions for a more stable and potentially durable next move higher are being created. This is the contrarian case, and it is not without historical support. Which interpretation is correct? That is the honest answer tonight. Both are coherent. Both are supported by real data. The resolution between them will come from the physical demand data that emerges over the next 2 to 3 weeks as Asian markets return to full participation and as the PCE inflation data and subsequent Fed communications give the market more clarity on the rate cut timeline. Let me pause here and ask you something directly. Drop a comment below right now. Where in the world are you watching this from tonight? I genuinely want to know where this community is located. Are you watching from India, from the UAE, from the UK, from the US, from Southeast Asia, from somewhere else entirely? Drop your city or country below. And while you're there, tell me your current position on silver. Are you holding? Are you waiting? Are you looking to add? Let the community know. The conversation in the comments is one of the most valuable things we have here. Now let us talk about the CME margin situation because it connects directly to today's price action and to the broader story of what has been happening in silver since late January. The CME Group, which manages COMEX, raised margins on 5,000 silver futures contracts to 18% from the earlier 15%. This is a 3 percentage point increase in the maintenance margin requirement. Now, if you are newer to futures markets, let me explain what that means in practical terms. When you hold a futures contract, you are required to maintain a minimum amount of capital, called margin, in your account relative to the size of your position. When the exchange raises the margin requirement, you need to post more capital to hold the same position. If you do not have that additional capital available, you are forced to close your position. Forced closing of positions means selling. And when many traders are simultaneously forced to sell because they cannot meet higher margin requirements, you get rapid downward price moves that can look dramatic. but are driven by mechanical liquidation rather than fundamental reassessment of the asset's value. The margin increase from 15 to 18% came after silver had already seen significant volatility from its January highs near $120 per ounce. The official justification for margin increases is always better risk coverage, protecting the clearing system from the volatility. But traders in the market read the timing and the size of these increases as having an additional effect, which is the deliberate squeezing out of over-leveraged long positions that could pose systemic risk if prices move sharply. Whether that secondary interpretation is accurate or not, the practical effect is the same. Higher margins mean forced selling from those who cannot meet the new requirements, and that mechanical selling creates price pressure that is disconnected from the fundamental supply and demand picture. This is why the 6% drop we saw today needs to be understood in the context of who is selling. If the selling is coming primarily from leveraged speculative traders who are being margin called or are choosing to de-risk ahead of potential margin calls, that is very different from fundamental sellers who are selling because they have reassessed the long-term outlook for silver and decided it is overvalued. Forced mechanical liquidation creates price dislocations. It creates opportunities for buyers with longer time horizons and unlevered capital to acquire positions at prices that the forced sellers would not have accepted under normal circumstances. Now here's the question that everyone in the silver market is trying to answer right now. How much of the selling pressure from margin hikes and speculative de-risking has already been absorbed? How much is left? The CFTC data showing speculative longs at a 2-year low suggests that a significant portion of the speculative excess has already been unwound. But 2-year low does not mean zero. There could still be more forced selling ahead if prices continue to fall and trigger additional margin calls on the remaining long positions. The $70 level is the critical floor to watch in this context. Let me talk about that $70 level specifically, because it is the most important technical reference point in the silver market right now. And I want to make sure you understand exactly why. Multiple technical analysts are pointing to $70 as a major floor in the silver market. As long as price holds above $70, the technical picture remains consistent with a buy on the dip framework. If silver breaks decisively below $70, the next significant support level is the 200-day exponential moving average, which, depending on current calculations, could be closer to the $50 level. That would represent a move of roughly 30% from current levels, and would fundamentally change the narrative around the silver bull market that has been running for the past 12 months. Now, I am not telling you that silver is going to $50. I am not telling you it is going to $150. What I am telling you is that the $70 level is not an arbitrary number. It is a level that the market itself has identified as the line between a corrective pullback within a broader bull trend and a potentially more significant structural breakdown. And right now, with silver trading at $72 to $73, we are only $2 to $3 above that critical floor. That proximity demands attention. The technical pattern that has been forming over the past several sessions adds another layer of complexity to this picture. Silver has been making what technicians call successive lower highs. Each time the metal bounces from a low point, the subsequent high is lower than the previous high. The $80 level has been acting as significant resistance during the early hours of trading sessions, and silver has been struggling to break and hold above it. This pattern of lower highs combined with the critical floor at $70 creates a compression scenario. The range between the ceiling and the floor is narrowing, and when ranges compress in this way, the eventual breakout from that range tends to be sharp and directional. The honest assessment is that right now we do not know which direction that breakout will be. If the compression resolves to the upside, breaking above $80 with conviction and volume, it signals that the corrective phase is over and the bull market is resuming. If the compression resolves to the downside, breaking below $70 with volume, it signals something more concerning about the durability of the silver rally. This is not a situation where you want to make large leveraged directional bets. This is a situation where you want to understand the levels, understand what each scenario means, and position yourself according to your own risk tolerance and time frame. Let me check in with you again right here. What is your read on the $70 floor for silver? Do you think it holds? Comment below. I read every comment, and your perspectives genuinely matter. And again, drop where you're watching from. I am seeing views come in from so many different countries, and I want to know which markets matter most to the people in this community. Now, I want to bring in the Indian market picture specifically for the viewers who are following silver on MCX, because the rupee-denominated silver price has its own dynamics that are worth understanding separately from the dollar-denominated COMEX picture. On MCX, silver March futures closed the last trading session, 4.33% lower at 2,29,000 rupees per kilogram before recovering 0.63%. The MCX Silver price is influenced by the COMEX dollar price as the primary driver, but also by the dollar-rupee exchange rate and by Indian domestic demand dynamics. India is the world's largest silver importing nation by volume in many years. Indian industrial demand for silver in solar panels, electronics, jewelry, and investment products is enormous and structurally growing. The Indian solar sector in particular has been a major and underappreciated driver of silver demand. India's aggressive expansion of solar photovoltaic capacity as part of its clean energy transition requires significant quantities of silver for solar cell production. Silver paste is used in virtually every solar cell manufactured, and as India's installed solar capacity continues to grow at its current pace, the structural demand from this sector alone creates a meaningful and durable floor for silver consumption in the Indian market. Indian investors have also shown a strong cultural and historical affinity for silver as a store of value and a component of household savings, particularly in rural areas. When silver prices dip sharply, Indian retail buying has historically shown up as a source of physical demand support. Whether that dynamic plays out in the current correction, with silver at $72 to $73 on COMEX translating to current MCX levels, is something worth watching closely in the coming sessions. Physical dealer reports from major Indian bullion markets in the next week will be informative. Now, let me bring in the broader macro picture, because everything we have discussed, the CFTC positioning, the margin situation, the technical levels, the liquidity conditions, all of it sits within a macro context that is itself in flux right now. The Federal Reserve released minutes from its January meeting this week, and the key takeaway is a split committee. Some officials are signaling willingness to consider further rate hikes if inflation remains sticky. Others are indicating readiness to support additional cuts if price pressures ease. The CME FedWatch tool currently has June as the most likely timing for the first rate cut of the year, but that consensus can shift quickly with each new data point. The PCE inflation report, the Federal Reserve's preferred inflation gauge, is due on Friday, and it is the next major data point that could move that probability either direction. If PCE comes in soft, confirming the softer than expected CPI data we saw earlier this week, the June rate cut probability firms up. Longer-term real interest rates decline. The opportunity cost of holding silver decreases. Silver's monetary appeal strengthens. If PCE comes in hot, the hawkish voices in the Fed minutes get louder. Rate cut expectations get pushed further out. The dollar potentially strengthens further. Silver faces additional macro headwinds on top of the technical and positioning pressures we are already dealing with. The dollar's behavior is particularly important for silver right now. A stronger dollar makes dollar-denominated commodities more expensive for international buyers, which suppresses demand from those markets. Given that Asian buyers, particularly from China and India, have been major incremental demand sources for silver over the past 12 months, a strong dollar that raises the effective price for those buyers acts as a demand dampener at a time when silver is already trying to find a floor after a significant correction. At the same time, and this is important to acknowledge, the dollar has been down 12% over the past 12 months in a broader trend context. The current dollar strength is a shorter-term move within a longer-term weakening trend. If that longer-term trend reasserts itself, it provides a tailwind for silver that is independent of any single piece of weekly data. Let me also address the geopolitical dimension briefly, because it is a factor that can move silver quickly and without much warning. U.S.-Iran nuclear negotiations are reportedly making progress. When geopolitical tensions ease, the safe haven premium in precious metals typically compresses. Some of the selling pressure in silver this week is attributable to markets pricing out some of the geopolitical risk premium that built up when tensions were at their highest. Simultaneously, the Ukraine-Russia peace talks concluded without a breakthrough this week, which maintains a level of geopolitical uncertainty in the background that historically supports a floor for safe haven metals. The geopolitical picture for silver is genuinely two-sided right now. Partial de-escalation on Iran removes some premium. Persistent Ukraine. Russia tensions and ongoing U.S. military presence in the Middle East maintain some floor. The net effect is a geopolitical contribution to silver pricing that is roughly neutral this week, neither a strong tailwind nor a strong headwind, but capable of shifting quickly if either situation escalates or resolves. Now, I want to give you the two scenarios for silver going forward as clearly as I can, because I think both are real possibilities, and you need to have thought through both of them before the next significant move happens. The bearish scenario for silver. PCE comes in hot on Friday. Rate cut expectations for June get pushed back. The dollar strengthens further. Asian markets return from Lunar New Year with muted demand as Chinese buyers assess a changed market landscape after the January correction. Speculative positioning, already at a 2-year low, continues to decline as remaining longs decide the macro environment is not cooperating. The $70 floor gets tested. If it breaks, the move toward the 200-day EMA, potentially as low as $50 in an extreme scenario, becomes a real technical possibility. The compression between the $80 ceiling and the $70 floor resolves to the downside. Margin pressure forces another wave of liquidation from remaining leveraged long positions. MCX Silver follows COMEX lower, amplified in rupee terms by any rupee weakness against the dollar. This is the bearish scenario. It requires PCE to disappoint, Asian demand to stay absent even after the holiday, and the $70 floor to break. If all three of those conditions occur simultaneously, silver faces a difficult next few weeks. The bullish scenario for silver: PCE comes in soft or in line on Friday. June rate cut probability solidifies. The dollar softens. Asian markets reopen after Lunar New Year, and Chinese buyers, who have been sitting on the sidelines during the holiday, view $72 to $73 silver as an attractive discount to their recent entry prices, near $120. Physical demand, which showed extreme tightness in January with dealers struggling to source metal, returns as a floor as buyers who wanted physical silver at lower prices finally get their opportunity. The CFTC 2-year low in speculative longs proves to be a sentiment extreme that marks the capitulation low. The remaining weak hands have been washed out. The market is clean enough for stronger hands to build new positions. The $80 ceiling gives way on a volume surge as Asian buying meets resurgent Western investment demand post-holiday. The compression resolves to the upside, and silver begins rebuilding the momentum that took it from $30 to $120 over the past 12 months. MCX Silver follows COMEX higher, and Indian physical demand adds an additional layer of support. The 67 million ounce annual structural deficit documented by the Silver Institute for 2026 reasserts itself as the dominant fundamental driver. This is the bullish scenario. It requires PCE to cooperate, Asian demand to return with conviction, and the $70 floor to hold. If those conditions align, silver could begin rebuilding from current levels in a more durable way than the January spike that reversed sharply. Which scenario do I think is more likely? I am going to be honest with you. I do not know. And anyone who tells you they know with certainty is not being honest with you. What I can tell you is what to watch and what the data will tell you as it comes in. Watch PCE. Friday morning, watch the Shanghai silver price on the first full trading day after Lunar New Year ends. Watch the CFTC report that covers the current week's positioning. Watch whether physical dealers begin reporting improved sourcing conditions or continued tightness. These are your real-time signals. They are more reliable than any prediction I or anyone else can make tonight. 3 key takeaways, and then we are done. Number 1, the 6% COMEX drop to $73 and the 4% MCX decline are real and significant. But the context matters enormously. Low Asian liquidity from Lunar New Year is amplifying moves. Margin increases from 15 to 18% are forcing mechanical liquidation from leveraged positions. Speculative positioning at a 2-year low, according to CFTC data, suggests a large portion of weak-handed longs have already been cleared out. The selling may not be over, but the market is considerably cleaner in terms of speculative excess than it was at the January peak near $120. The $70 floor is the line that determines whether this is a buy-the-dip opportunity or the beginning of something more concerning. Number 2, the technical picture is demanding respect right now. Successive lower highs at the $80 level, a compression forming between the $80 ceiling and the $70 floor. The 200-day EMA as the next meaningful support below $70. This is not a technical picture that supports aggressive leveraged long positions right now. It is a picture that calls for patience, for watching the range compress further, and for waiting for a clear directional resolution before committing significant capital. The range compression will eventually break one way or the other. Waiting for that break with volume confirmation before taking a large position is the disciplined approach in this environment. Number 3, the macro picture for silver remains genuinely two-sided. Softer inflation data supports the rate cut case, which is medium-term positive for silver, but the same soft inflation compresses the immediate inflation hedge premium. Fed minutes show a split committee with hawkish and dovish voices competing. PCE Friday is the next resolution event for that uncertainty. Asian demand returning post-Lunar New Year is the physical market signal to watch. Geopolitics are partially de-escalating on Iran but persistent on Ukraine. The dollar is short-term strong but longer-term weak. Every one of these factors is real. Every one of them matters. And right now they are genuinely balanced between the bullish and bearish case. That balance will not persist indefinitely. PCE Friday and the Asian market reopening in the next week will start to tip it one way or the other. Before I let you go, I want to hear from you one more time. Where are you watching from tonight? Drop your city or your country in the comments right now and tell me this. At $72 to $73 on COMEX, Do you view silver as a buying opportunity, or are you waiting for more clarity? Are you already holding physical or futures positions from higher levels and deciding what to do? The community here has people at every stage of this journey, and every perspective is valuable. Drop your thoughts below. If this kind of analysis is helping you see the full picture, understand what the data actually means, and think through both scenarios before the market forces a decision on you, hit subscribe. That is how this community grows. Not through hype, not through telling you what you want to hear, through showing you what is actually happening and letting you make your own informed decisions. I will never sell you the moon, and I will never sell you the apocalypse. I will give you the data, both sides, every time. Do your own due diligence. Understand your risk completely. Be accountable for your own decisions. Know your time frame before you make any move. Are you a short-term trader watching hourly charts, or a long-term investor building a position over years? Because the answer to that question changes everything about how you should interpret every single thing I told you tonight. And if you are new to these markets and you do not have a plan yet, please be careful. Environments like this one, 6% single session drops, margin hikes, compressed ranges near critical floors, these environments can be extremely punishing for capital that is deployed without a clear plan and a defined risk management approach. Invest with logic. Use your brain. Do not follow anyone blindly, including me.